Good evening. I would like to go over the management's financial statement assertions with you in this video. So there's three things that I would like to cover. So the first is just a basic overview of what are assertions. And then there are two standard setting bodies that set the assertions for auditors that we need to follow. That would be the ASB and the PCAOB. So I want to go over the different assertions from those standard setting agencies as well. So what are these things called management assertions? Well, if we were to look up the definition of to assert, it means to state a fact or belief confidently or forcefully. So what we're saying is that when management hands over those financial statements to the auditors at the beginning, they're making certain claims about those statements. So for example, they're making an unstated claim. They're not coming out and telling us in words, but they're basically telling us by handing them over that everything recorded as revenue actually occurred, that those sales actually took place. They're telling us that the assets actually exist. They're telling us that the investments are valued correctly. So again, this idea of assertions is that management is making claims about these statements and about certain criteria relating to those statements. And it's our job to find evidence to support those assertions. So what are these assertions? So we have two standard setting bodies that we need to follow. So the first is our ASB, or Auditing Standards Board. These guys are going to govern our audits of non-publicly traded or non-issuing clients. So if we have a private mom and pop shop or just a privately held company, they're going to follow our ASB criteria when following or completing the audit. And the assertions that we're going to use are completeness. So CAVE-CROC is my acronym there for you to help you remember this, but completeness, all transactions, assets, liabilities, and equity that should have been recorded are recorded, and all disclosures are included. So nothing is missing, everything is complete. The A stands for accuracy, the amounts recorded and disclosed appropriately and in accordance with GAAP. So we haven't transposed any numbers. Everything has been recorded on the correct date. That would be accuracy. Valuation is very similar to accuracy. So valuation and allocation tells us that assets, liabilities, equity, and disclosures are included at appropriate amounts. So you might look at those and maybe think that it's hard to tell the difference. I like to think about accuracy as when we are initially recording an amount, and valuation is subsequent evaluation of that particular item. So for example, inventory. We originally record inventory at one amount. That would be accuracy. When we look at it a year later to see if it has become obsolete and needs to be written off, that would be valuation. The E stands for existence. So assets, liabilities, and equity actually exist. So everything that's listed in our asset list, we can actually go and find. So that's CAVE for CAVE-CROC. Then we have the CROC part. So C is for the second C is for cutoff, meaning that all transactions and events are recorded in the correct period. So we don't have some January sales that we're recording in December to boost up that revenue at year end to make sure that we hit our targets. We're recording it in the correct period. January sales are recorded in January. The R stands for rights and obligations. So rights deals with ownership of assets particularly, and obligation is that the liabilities are actually the obligation of the organization. So a lot of times rights you'll see on consignment sales. So do we have the right to include those assets that aren't physically in our location on our accounts? The O stands for occurrence. So recorded transactions are disclosed. So sales actually occurred. And then finally, the C stands for classification and understandability. So financial information is appropriately presented and described. Those notes and disclosures are clearly presented. So those are our ASB assertions. The PCAOB assertions are actually very similar, and a lot of the things are exactly the same. So we have completeness. CVOP is my acronym to help you remember those. So we have completeness, same as in CAVE-CROC. Existence and occurrence, those are kind of two sides of the same coin, so we lumped those ones together. We have valuation again as well. You'll notice we don't have accuracy because accuracy and valuation are very similar, so they just kind of put those ones together. We have obligations and rights instead of rights and obligations. And then instead of classification, we have presentation, which really means the same thing. So again, you see that even though we go from having 8 assertions to 5 assertions, they are really identical in all important ways. So those are our assertions. The quicker you get these memorized and understand the different assertions and how we can test these, the better off you will be, because I'm telling you right now, these never go away. So you're going to see these on my exams, you're going to see these on the CPA exams, and then if you're ever working in audit, you're going to see these on all of your audit plans as well, because every procedure you do, you have to link back to a management assertion, because ultimately what we're trying to do is provide evidence that these assertions have been established. So that's all for now, folks. Have a great night.